Good morning, and welcome to the Energy Prospectus Group webinar hosted by Hemisphere Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Stephens, who will introduce today's speaker.
Hey, everybody, welcome. And we really appreciate you supporting EPG and attending our webinars. It's really helpful. I am pleased to have Don Simmons back. He's CEO of Hemisphere Energy. This is about the third webinar I think they've done. He's going to give us an update on Hemisphere Energy's operations. 2021 was a profitable year for the company and shareholders as the stock price actually gained over about 350% in the last 12 months. The company is well positioned for strong production growth in 2022. Hemisphere is one of my top picks in our small cap growth portfolio, and it is heavily weighted to oil. In fact, about 99% of the production is heavy oil. The company's production increased 49.7% in 2019 and still increased another 2.4% during a very tough 2020 when I don't think they completed any new wells. And Hemisphere should report production growth of more than 6% when they report their last quarter in 2021. Production has increased about 9% in early 2022 with some new wells, and after averaging 2,100 BOE per day in the fourth quarter of 2021. Hemisphere generated over $8 million of free cash flow in 2020 and close to $10 million of free cash flow in 2021. The balance sheet is now in great shape. Based on the company's 2022 guidance and assuming WTI averages $80 US per barrel, this year's free cash flow should jump to more than $30 million in Canadian dollars. That is enough free cash flow to pay off all of Hemisphere's debt and fund some bolt-on acquisitions. So now I will introduce Don. He is a geologist. He spent the first 5 years of his career working with Encana, which has had a name change to Ovintiv, which is one of our Elite 8 companies, before moving on to Sebring Energy, a private company that was sold in 2007. Don joined Hemisphere Energy in 2007 as the company's VP of Exploration. He became the president and CEO in February of 2008. He's done a great job building the team at Hemisphere and guiding the company through a very challenging year in 2020. Hemisphere is now generating strong cash flow from operations, and it is positioned for significant production improvement and reserve growth in 2022. With that, I will turn the controls over to Don, and I remind you to type your questions into the chat box. I've been sent about 12 questions, so I got a pretty long list already. But if you think of anything during the Q&A, just type it into the chat box, and I will return at the end of his presentation to go through the questions with Don. So take it away, Don.
All right. Well, thanks a lot, Dan. Great introduction. You kind of touched on all aspects there. And it wasn't that long ago, actually, I was able to come down before Christmas. I think it was late November, December, and give some in-person updates, which was great, first in a while. And so we've had a couple of news releases since then, and you know, I thought it'd be a good time to give everybody an update. And so I'm not going to dwell too much on the presentation and some of the details there. I will hit on some of the highlights and what to look for, and then really get towards that Q&A towards the end that you know, everybody can kind of ask me you know, any questions they've got on Hemisphere or anything just in the overall energy market or the Canadian market anyway. So again, you know, just to remind everybody, we are growing. You know, we are small. We're one of the smaller juniors out there. So it's not just about return to shareholders. We are actively looking to grow and continue to build value. So, you know, what are we growing? Production, obviously, as Dan had chatted about through 2021 and through 2022. We're looking to grow our production, grow our cash flow, and grow our reserve value. And, you know, I think there was a few people had mentioned sort of what are some of your, you know, how do you evaluate things? And you know, here's some of our guiding principles on how do we run Hemisphere, how we built Hemisphere, and what do we look for in assets as we go forward as well, if we're looking at any acquisition opportunities. One, you know, keep it simple. keep it clean, be profitable, and we like to be somewhat unique to entice investors to invest in us versus some of the other opportunities out there. So, as we sit today, what do I mean by simple? Again, it's that we really have one core area. We've got 2 conventional oil pools there, a lot of oil in place. We've really just continuing to develop those pools, and so that's why we're able to really focus on these assets and get as much value out of them as possible now and as we continue to develop in the future. When we talk about clean, really looking at, we don't have a lot of decommissioning liabilities. We try and leave as little footprint in the field as possible. The farmers love that we work with out there, and obviously from a minimal decommissioning liability, that's something that takes away value from shareholders. The more wellbore liabilities, facility liabilities that you have, that really just comes off what value you've built into the company. Be profitable. I mean, it seems obvious as a company, but there's a lot of companies that struggle. There's certainly, as we've seen ups and downs in the oil price over the last number of years, and we know as an oil company we can't control the price of oil, but we can control our costs. And so again, we try to drive down our operating costs, drive down our G&A, and then look for pools and look for opportunities that aren't that expensive, that do have low operating costs, and allocate our capital there. Another thing that kind of falls out of that profitability, when you look at our reserves, you look at our per barrel reserves, we're top tier in all of those categories: PDP, proven, and 2P. And again, it really reflects the type of asset we have. Being unique, I mean, one thing that we have done over the last number of years, even as we continue to pay down our debt and grow the company, we have had an active share buyback program. We'll continue to do that as a form of return to shareholders. We also look for other ways to return to shareholders as we move in the future. And another part of that is approaching a low debt, low or no debt if we choose to, which is also unique in the oil and gas business. Some of the key numbers and where we're located. For those of you that haven't seen the presentation, we are in Southeast Alberta. It's an area called Atlea Buffalo. That's where the bulk of our production comes from. It's about 3 hours east of Calgary, about an hour north of the city of Medicine Hat. So a very easy place to do business, access year round. And so, great people and supporters in the area, lots of infrastructure, lots of service companies able to meet our needs there. Looking at the key numbers, we trade in Canada on the Venture Exchange, HME, down the US on the OTCQX on HME NF. I did this presentation a couple of days ago. We were trading at $1.18. I think we've traded up here this morning closer to $1.30 in Canada. Insider ownership, we're about 13% on a basic level. We've got just over 91 million shares out, fully diluted, 109 million. So that gives us a market cap of right around that 108 and an enterprise value of about 126. That's using the end of Q3 debt number in there. That's the last debt number in the market. I think it's just over $18 million Canadian. Some of the latest production numbers out in the market. We have said, looks like we did average in Q4 about 2150, and that's 99% heavy oil. And we just put out a news release here earlier this week that with our new wells on in the F pool, that we were drilling when I was down in Houston and Dallas and Atlanta there before Christmas. We brought them online. That, along with continued success in our EOR projects, the Polymer flood and our G pool, we're seeing production over between the 23rd and the 5th here, with everything up and going, almost 2635. So record production for the company. Great to see. We're all pretty excited about that. When we look at these decommissioning costs, we like to highlight how low ours are. Only $8 million undiscounted. You discount that and it's under $2 million. And linked to that, in Alberta, they do a rating called the LMR. And it's really just a ratio of our assets, producing assets to liabilities, and we're 10 times our assets to liabilities. So puts us in the top tier of Alberta companies. And I'm not going to dwell too much on this. It's really just to highlight the valuations. Again, these reserves are from year end 2020. Our new reserve reports, usually we bring those out in March. So, stay tuned for that as we get into the next month. But highlighting last year's values is still important because we're still trading significantly below them. When you look at our proved plus probable reserves, discounted at 10%, valuation of $211 million and just under 15 million barrels. And on a proved basis, discounted at 10%, 170 million and 11.7 million barrels. And on a blowdown case, or our PDP, discounted at 10%, 81 million. And just over 4 million barrels. So again, stay tuned for the new ones. Why do we like reserve? It's a great way to compare ourselves to other companies out there. It's important to note that, what do these reserves include? It's all the future development capital, at least that you're aware of at the time. Operating and transportation costs are included in there. Royalties are included there. And all of the decommissioning liabilities now in Canada have to be included by everyone, which we think is great. It's certainly an advantage to Hemisphere. Another thing to note on those valuations and the numbers I talked about there, those were run at a pretty conservative price forecast. $47 for 2021. We know now it came in close to $20 higher than that. And it didn't, the price forecast used there by the auditors, it didn't hit $60 to 2029. So again, we think that's a fairly conservative. Looking forward to getting our new numbers out there. A couple of the key metrics from our reserves, again, looking at the past 2 years, we didn't have a huge amount of Capex, but we were able to find barrels at an extremely low price, really a function of our EOR projects. Our F&D costs are just over $2.30 a barrel, and our proved reserve life index of almost 19 years. So a couple things to note. As I mentioned, we expect our report in March. Through 2021, we drilled 7 wells out in the field, and we implemented our G-Pool polymer flood. That started up in mid-year. So what are some of those numbers when you crunch it back to a debt adjusted reserve value? I've highlighted on there. You can see the green dash line sort of going across. That's our share price, about $1.18 a share back on February 8th. And then if we looked at those three within the red box, the total proved numbers. And truly, why do I highlight that? I really believe in a good oil market. Companies and good companies should trade at least at their proved value, if not slightly above. So when we look at the 3 different price sensitivities there, if you look at the consultant price forecast, it's $1.67 for Hemisphere shares at a $60 flat, $60 WTI flat. It's just over $2. And at a $70 WTI environment, which we're well above today, over $2.50 a share. So gives you an idea. Another way to look at companies other than reserves is cash flow metrics and seeing where their debt to cash flow is. So let's look back. What's in the public market today for Hemisphere? It's Q3 numbers. So again, this is actually the 9 months up till the end of Q3. We averaged just over 1,700 BOEs a day. The revenue from those 9 months was about 28.5 million. Our operating field netback was 18 million, and our cash flow or adjusted funds flow on that was 12.3 million, or $26.50 a BOE. We had spent up until the end of Q3 6.3 million, and we exited the quarter at 18.2 million in debt. So when we compare that now to 20 of our peers under that same time frame, on a cash flow per barrel basis, that $26.50, we're number 2 out of our 20 of our peers. So that's fantastic. And if we look at us from a net debt to cash flow basis, we're 1.1 times, puts us in the top 4 of those 20 companies. So again, great balance sheet. We've really worked hard to really strengthen the company, strengthen the balance sheet over the last couple of years here. So now let's take a look at where we're headed, where we're going, and this was something we've put out since I was down in the U.S. Before Christmas. So this is our 2022 guidance at $75 WTI. So we're looking to average about 2,600 barrels a day and exit the year at 3,000 barrels a day. And at $75 oil, cash flow or funds flow is expected to be about 37 million or about 40 cents a share. We currently have capital expenditure plans of $9 million. And this leaves us free cash flow or free funds flow of $28 million. So, when you look down below there, where's all this money going? We really have the set plan of the 9 million going to capital expenditures. And then the rest is sort of discretionary. We're strong believers that continuing to pay our debt down makes us a stronger company. So you'll continue to see us lower that debt number. And then we have additional capital there, or additional money there available to us that, I'd call it discretionary, that we can move it to where we see the best fit and the best rate of return for shareholders. Is that, accelerating existing projects? Is it making acquisitions to make us a stronger company? And is it continuing to return capital to shareholders, either through our continue our share buyback program, and we've even said publicly as we get stronger and bigger, looking at potential dividends in the future. So looking at some price sensitivities there, what happens if we see a negative impact on oil prices down to $65? We're still looking at great numbers, over 30 million of cash flow for the year. Again, on the flip side, oil goes up and averages $85 for the year. We're looking at over 40 million of cash flow for the year. So, looking very strong. And again, just to remind people, it's a balancing. That's what we discuss every day. And, what's the best place to allocate that capital to increase value the most for all of our shareholders. So let's take a little review of the pools that we have. So it's 2 conventional oil pools. There's about 84 million barrels total oil in place between the 2 pools. The reservoirs have a current recovery of about 5% of that oil. These pools, there's lots of old vertical wells that we've used to delineate, and we've either acquired or shot 3D seismic over all these pools, so we have a very good understanding of them. And both reservoirs are now under enhanced oil recovery methods. So in the F pool, it's still water flood. In the G pool, it's a polymer flood. We converted it to polymer in 2021. And these pools, it's important to get across. They're low risk. We know the oil's there. They're low cost to drill. Wells are, under $1 million. Op costs are in that sort of anywhere. We've been from $10 to $13 a barrel. We have low decline because of the EOR methods. And it's a really nice assets to have and build a company from. And we have existing facilities now in both of our pools, and we have been expanding those. We've expanded those facilities in 2021, and we can easily expand those in the future as we continue to grow that production. So we look back at last year. What did we do? We drilled 7 wells out there. We implemented the polymer flood in the G pool, and then we did spend some money certainly later in the year as well, on upping our facility capacity for our production growth. As we come in and work our way through 2022, the first thing we've done here, and we let the market know, we brought those 4 wells we drilled late last year in the F pool. They're all online now as we came through January. January was a pretty tough month up here. The first couple of weeks we were seeing temperatures as low as sort of -35, -40. So delayed us a little bit in getting those online, but we've got them all up and running now. We plan to drill 3 additional wells into our G pool and continue to optimize our polymer flood there. We will need to continue to build out those facilities as our production continues to increase. We've talked more and moving now towards converting our F pool. We've kind of made that public here this week that we're happy with what we're seeing. We don't have timing around that yet, or a lot more details, but we certainly through the science and the modeling we've done, we like what we're seeing, and certainly in this oil price environment. And then one more thing that you haven't heard us talk a lot about over the last number of years, really because of the oil price environment, is a look to more exploration activities. Of course, we're always looking at acquisition opportunities, but given where we are today and where we sit, we are going to look for areas for future growth. And certainly some of the things we've worked on over the last number of years, we're going to test a few of these things as we go through 2022 and 2023. So why polymer? Those of you who've heard the presentation or seen me before, you've heard me talk about this. This is not new technology. It's new for Hemisphere, but a lot of companies have been using this technique around the world in numerous oil pools. It's really, we're just adding a powdered polymer to our water injection system with the goal of increasing that viscosity. And when you think about it, it's just trying to get that water to a viscosity, something that feels or looks almost like an olive oil. So just as you inject it, you can see the diagram there. There's 3 horizontal wells. The polymer is injected into the middle well. It builds this wall between the water and the oil, and has a more efficient sweep of that oil from your injector over to your producers. And it kind of limits, water likes to travel easily through the reservoir. So you're limiting that streaking through to your producing wells. So what do we look for? We look for an oil production increase. We look for water production decrease, so we save on some operating costs. But overall, the real goal here is to be able to get more oil out of that reservoir that we know is there. ESG, again, you guys have heard me talk about this. Canadian companies and Hemisphere is definitely including that. We are always committed to the highest standards, and we will continue to be, and we will continue to be better. There's a number of different initiatives that Hemisphere focuses on, both from the environmental side, but also working with our communities, hiring local companies, supporting the people in our communities is very important to us. And obviously from a company culture, safety is number one for our employees and the people that out in the field, and really the buck stops at the top. Culture of accountability and honesty, and it trickles right down to the bottom. That being said, that comes from our leadership. We've all worked together here for quite a number of years building Hemisphere, and we're backed by a very supportive board, and continue to work towards striving and getting better and better as a company. So that's really it. I think happy to hand the keys back over to Dan there and answer all the questions.
Hey, Don, good job. Thanks for the update. I just want to remind everybody that Hemisphere is in our small cap growth portfolio. I've been following it at least for 5 years, probably more like 10. Time flies the older you get. But anyway, they made a lot of progress and continued to, grow production even during the worst part of the pandemic. So I'm really proud of this company, and the share price has tripled for us in the last couple of years. So here's some questions that I had sent to me and some that I put together, but let's just go through that. On Wednesday, you announced that production had increased by about 500 barrels a day BOE per day since December, thanks to the 4 new wells at Atlea Buffalo, the F pool, and a production response from the Polymer flood at the G pool. Can you give us the production split? How much of that increase in production comes from the Polymer flood and how much from the new wells?
Sure. And Dan, can everybody still see the presentation if I flip to?
Yeah.
Okay. So I might, as we're talking about this, just flip to a couple of different slides to make sure I get the answer across. So if you look at our production growth, so Q4 averaged about, I think we got there 2150, and our latest number was 2635. So you got to remember, there's been a lot going on. We had a very active, basically last 5 months here, where we drilled 3 wells in the G pool in September, and those wells started coming online in November. So if you remember one of our previous news releases, we talked about, I think we exited Q3 at almost 1,700 barrels a day. We brought those wells online at the same time. We're optimizing. We've got the Polymer flood kicking in. And so we averaged 2150, but then we exited through December at about 24. I think we put out 2,400 barrels a day through the month of December. So that really is a reflection, that growth of the 3 new wells in the G pool that were drilled in September coming online, plus growth from our G pool, some of it Polymer, some of it just speeding up pumps, optimizing. And then the additional production here, I would say, going from the 2,400 to the 2,650 or whatever it is there, 2,635. I think that's really a good reflection of the additions of the F pool wells. So in that sort of 200 to 300 barrel a day adds from those 4 wells.
Okay, so the G pool is not really from new wells. It's going up gradually, because you would be on decline. I mean, we'd have declined if not for the Polymer flood, right?
Oh, correct. I mean, that's the thing, is people ask me, what's your corporate decline? And it's almost impossible for me to answer, because we're still actively developing. But even if you try and strip those new wells out, we're adding injectors. We did last year as well. Which, you might get a bit of a production bump when you turn a well off that was producing oil and now start injecting into it. But then all of a sudden, 2 or 3 months later, the offsetting wells have increased production significantly because of that addition, right? So you're right. We're inclining at certain points in time in our production because of the EOR schemes, because of, the water flood in the F pool and the Polymer flood in the G pool.
Yeah. Okay. Okay, if WTI averages $90 US per barrel in the first quarter, what will Hemisphere's realized oil price be during the first quarter, net of cash settlements on the hedges?
Yeah,
and I guess that's in Canadian dollars, by the way.
In Canadian, yeah. So getting basically to a wellhead price there. I plugged in 90 for those, average for the first 3 months, and came out with about a $78 wellhead price.
Okay.
Canadian.
Yeah. And to remind everybody, their oil is heavy oil. So it does sell at a discount to the light oil up there.
That's right. It basically, what you do is you take the WTI price in US and you minus off what we call the Western Canadian Select Differential, which right now is about $13 US. So you minus that off of the WTI price. Then you convert to Canadian dollars. So we're trading right now the US to Canadian dollar. It's about $1.27 in our favor. So we get a big bump then on the Canadian price. And then for our heavy oil, it fluctuates a little bit, but somewhere in, I think I use an average of about a $4 quality adjustment. And that's how we come up with our wellhead price.
Okay. And how much of that is coming off because of hedges, you think?
Well, Q1, do I still have that up there? Q1, we are still looking at some pretty big legacy hedges, and roughly about $12 a barrel we're losing in hedges in Q1. So we've only got about 50 days left of those swaps.
Yeah.
Not that I'm counting, but yeah, so it'd be nice. I mean, those are legacy that were requirements from the past, from our past lender, and you know, they seem like they were a good number at the time, but we got even better oil prices today.
Yeah, and that's one thing to remind people. You know, as these I call them, as the bad hedges expire, that also will add to the increased realized oil price. So, you know, assuming we continue up here in the $80-$90 range for WTI. So anyway, so in next question. So in Q3, Hemisphere's production averaged 1670 BOE per day and is now 2,635 BOE per day. That's outstanding. Let's see, based on engineering estimates, how much could production increase at the G pool over the course of 2022 and 2023? Thanks to the Polymer flood. And I do know you're also going to drill 3 more wells in the G pool this year. So it's really, you know, we're kind of looking, what's the upside for the G pool?
Yeah, and I guess, you know, we do model and in our reserves, we do see some upticks there. You know, I think our guidance that we put out of 3,000 barrels a day, that includes those 3 wells we're drilling, plus some increase in the G pool Polymer flood. We do, you know, we have anticipated some of that. We're a little bit cautious and a little bit conservative on that. I think you know, it's just one of those things. You don't want to make a, you know, promise based on some modeling and it's a little slower than you expect or something different. But we certainly are anticipating continuing to see increases from that Polymer flood. Yeah.
Yeah, it's always better to under promise and over deliver.
I have found that it goes better that way in our business. Yep.
Yeah. And I did update the Hemisphere forecast model on the EPG website yesterday. And I now think my first quarter production is a little bit too low, but my assumed oil price was $80 WTI for the first quarter. So that's a little bit high maybe, but I think they'll balance out and get to where my new valuation is. But let's see. Will the Polymer flood, and I go back to when I was at Hess, you know, we had a CO2 flood. And it took a while. It took 6 or 8 months before you start seeing any impact from the CO2 injection. But then once we did, it was a steady increase in that field. And in fact, it became one of the best EOR projects in the entire world for anybody. So do you see that with the Polymer flood? How long will it take before you really see the full impact of the polymers in the field?
What I think it'll be ongoing because we're still drilling wells, right? Like we haven't, you know, I'm not sure the case of your CO2 flood, but a lot of times it's certainly the pools that I've been involved with in the past is that the pool is completely developed with wells and maybe was under water flood, and then it gets converted. But in our case, we're actually still drilling wells and converting wells as we go, right? So it's going to be a bit of both, the growth in that pool continuing from obviously continued success with the Polymer, but also continued success in drilling new wells and developing the entire pool.
Right. And that kind of leads into the next question. How many additional development well locations are yet to be completed at Atlea Buffalo in both the F and the G?
Okay, so yeah, I know our corporate number, which includes some other areas and plays, is probably close to 40 locations. So I think if we're looking at G and F, you're probably looking somewhere in like maybe 25.
Oh, okay. Like how many producing wells are now in the G pool?
Oh goodness. Let me see here. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 14, 15, 16, 17, about 16 or 17.
Okay. And then you still have what, 8 or 10 more producing well locations there?
Yeah. Yeah.
Okay.
There's still another, there's still a
Okay.
handful more locations to drill. Yep.
Yeah. So then you'll continue to drill new wells, and then you'll convert a few of the old ones into injecting wells.
That's right. Or,
Okay.
in some cases, even if we drill a new pad, we might drill 3 wells off that pad. We'll produce all 3 for a period of time until we start to see, a decline in those wells and that production. And then we may convert. Usually it's the middle one so that it affects
Right.
on either side. But again, it sort of depends on the pattern where we are in the pool.
Yeah. How much according to engineering reports and everything, what you got, what's the potential of increase in recoverable reserves as a result of the Polymer flood?
Oh, I don't have that number in front of me. That will be a good question to ask me the next time we talk after our reserve report, because I will, we'll see that and where McDaniel is in that. I can talk to some analogs, I guess. I know, in the past, we used to have some analogs put into our presentation of some pools in the greater Atlea area that have been under either polymer flood or even sort of a more chemical ASP flood. And we saw everything from, 25% recovery factors or on their way to there up to 35 to 40% in some of the smaller pools that had really amazing recovery.
Yeah. Do you think are the engineers going to give you any P1 reserve? Will they move some reserves into P1 as a result of the polymer flood so far?
Well, they did last year.
Okay.
Proven reserves. They looked at our data and our modeling, and we had already paid or put the deposit on our polymer skid, so they knew we were committed to doing it.
Okay.
So they, we had some in our proven value last year. I think the big thing we'll see this year will be that conversion from proven reserves then into your PDP. Because now they're actually producing. Right?
Yeah, that's good. And I'm very reminded, go back to that slide where you did the valuation based on last year's report.
Right here.
Yeah, that thing. And now that's based on 2020, the reserve report, right?
Correct. This is out of date, basically. This is
very out of
date. Be updated. Now, if you remember before Christmas when I came, I also had another slide or two here where I compared ourselves and our reserve value to our 20 peers. I've removed those because some of our peers, a few of them have already come out with reserves for year ended 2021. So it's irrelevant now that those slides that I had. So, that's something we'll look at again. Once we've come out with ours, or once everybody's sort of released their reserves, we'll be able to update that and again compare where do we sit compared to our peers there.
Yeah, and just how do you come up with the oil price up there? Is it different? We down here, we use the SEC requirement is looking at the previous 12 months, so we're still using out of date oil prices in our reserve studies.
That's right. So they certainly have moved up here to a more of a formula that is tied to the price at the end of the year. So, in this case, when we look here, the price of oil in late December in 2020 was around $47, $47. So they tie that next year to that. And then they sort of say they follow a little bit of strip for the first few years out. So in many cases, and this year it'll be the same, it'll actually come down a little bit because the strip is backwardated. So it'll come down a little bit, and then they have just an inflation adjusted number going out into the future.
Okay, so they're probably going to be using something like 67 or so. Right.
I don't have, I know what it is. I don't have it in front of me, but yeah, it's whatever, again, the price ended last year at, which I don't remember what it was at December there, but it'll be, that in the near term coming down like strip, and then inflated going out just based, 2% inflation or something like that.
Yeah. Just a reminder to everybody too, all those year-end reserve reports, when they come up with a estimated discounted future cash flow. That includes all well drilling, completion costs, operating expenses, everything in there. So let's say they got 25 more wells to drill. The cost of those new wells will be in there, and also which will be inflated a little bit because service costs and stuff are going up, and also all the costs of operating and taking out royalties and stuff like that out of it. So, and then they get that, and then they do it for the next 20 years of cash flow, and they discount it at 10%. So they call it the PV10 value. Then companies will take that, subtract all their debt, and you get a PV10 net asset value, which a lot of the analysts look over. But that should be significantly higher than Hemisphere's current price when this comes out at the end of March or April. So anyway.
And I think it's important to note, Dan. I mean, I think reserve reports have tended to get a real bad rap, and a lot of people I've heard, like even guys that I know that have been oil investors for decades, they don't trust them, or they don't they don't like them, and I don't have that view. I mean, I think any report you have to understand it and dig into some of the numbers, but this is something that this is done by a third party. They're done by engineers. There is certainly, when you're looking at proved, I mean, they have to be 90% sure or confident that you'll be able to capture those reserves.
Mm-hmm.
And you're right. I mean, everybody that tries to build their own Excel spreadsheet model of valuations and all this kind of stuff, I mean, nothing could be more detailed than what people are putting into these reserve reports. Now, again, probably the biggest variable is that price forecast that's in there. That's where
right. That's the big number.
Look at that. Price goes back to $30 oil. I can tell you your reserve report valuations are not going to be they're going to be off.
Yeah, and the higher price actually adds more recoverable reserves because it extends the economic life of the wells. That's another thing to remember. It does add barrels just because the price goes up, and it subtracts if the price goes down, because then the wells would fall below their economic limit earlier, if that's the assumption.
That's correct.
But anyway, when I was at Hess, they tend to be very conservative. In fact, we would have reserve revisions were always up, and especially when you're talking about your Atlea Buffalo assets are very well known, very well defined by vertical wells and seismic. So you're not talking about any wild thing, and know where the fault lines are and all that kind of stuff. So very, very conservative. So that your reserve report should be way more accurate than what a lot of people put out. Okay. So the next reserve report, you think it'll be out by the end of March?
Yeah. Last year was sort of mid-March. I think we've been told and indicated we're kind of roughly on the same timeline with the auditors. So yeah.
Okay. Let's go look at the balance sheet now. The balance sheet showed 18.2 Canadian million dollars of net debt at the end of September. Were you able to reduce debt further in the fourth quarter?
Yeah, we don't have any numbers out there yet, but I do know Q4 was very capital intensive. We drilled the 4 wells in F, and we did some facility upgrades. But I would say that we didn't spend all of our cash flow in Q4, so we should see a reduction on that a bit.
Yeah, it's either paid down debt or it's sitting in cash, right?
Well, and in our case, I mean, the way these things work, you don't ever sit in cash, because it just goes right to the line. The moment it comes into your bank account, you get paid in Canada, we get paid on the 25th of the month, and it goes straight on to your revolver, and then you draw on that through the next month that you get paid again.
Yeah, and talking about the revolver, see, they got a revolver that paid off all this other debt that was a private equity firm, and so now they're just doing bank. You're really not going to want to pay off the entire revolver. I would think you'd want to keep it in place, right? You want to keep a relationship with the bank.
Well, it's funny because I mean, they read some of our news releases, and we talked to our guy over there, and he's like, "God," he says, "we're not going to make any money off you guys." So, it's there's somewhere that makes sense, right? And you're right. I mean, paying 4% or 4.5% or whatever we pay, it's doesn't make sense to run at zero. All I know is getting our debt down further, becoming a rounding error, whether it's zero or whether it's a few million or 5 million or whatever it is. It just makes us a stronger company. It gives us that ability that if some unbelievable opportunity does come along, we've got the balance sheet to act on it if we choose to.
Yeah, and you can get net debt to zero if you just build up your cash. I mean, you could get there. You don't have to give it to the bank. You can get there the other way by building up the current assets. But anyway, the other thing, let's see. But okay, on Capex spending, now you completed those 4 wells in just recently, so you're not going to have too much more Capex, are you, until the summer? Because aren't the 3 G pool wells to be drilled this summer?
Yeah, we usually like to drill in the summer, or late Q2 is usually when we can, we get through breakup. Your road bans are off, and that's typically when we like to get out there and drill some wells. So yeah, it's not. We've got a few things on the go, but yeah, not a terribly large Capex plans for the first 4 or 5 months.
Anyway. Yeah, I remember we pretty much up in, we were in the Bakken, so in North Dakota, you have the same situation. They call it spring breakup. When you start getting thaw, you can't drive big machinery around because it messes up all the roads. But so you're not going to have much Capex between March, April, May, and you might start up the drilling program, drill the 3 wells in the summer. Now, then, I mean, if you've got a whole bunch of cash flow and the oil price holds up, is there a potential to add more wells like in the fourth quarter, take advantage of the high prices?
Yeah, potentially. I mean, for us, as a small company, it's one thing we've always said is we need to be flexible, be nimble. You saw a great example of that in the fourth quarter. We couldn't believe that we couldn't get a rig in Q1 to go do our program. So we mobilized as quickly as we could, and we drilled those wells we had planned to do in Q1. We ended up drilling them in Q4. So, we'll continue. We sort of pride ourselves in being able to be a company like that can take advantage of opportunities. And, if we need to step on the gas for, because it makes sense to do it, then, we'll do it. If we got to tap the brakes now and then we'll do that too.
Well, there's a lot of talk out there about WTI going over 100, and I can see it happening. So when will you guys be fully committed to the polymer flood at the F pool?
Yeah, in our last news release, I would say we're committed.
Yeah. Okay.
I didn't put the fully in front of there, but we are committed. We want people to know that we are committed.
And how would you? Do you view the G pool as better? Or the F pool, or are they about the same?
So no, the G pool definitely, it has a little higher porosity, higher permeability. It's thicker. There's more oil. It really is the crown jewel. That being said, the F pool is no slouch either. So, we wanted to be sure, we really wanted to see the response from the G pool, understand how this whole thing works, and cost, make sure our cost estimates were in line, and any of the technical things. We ended up redoing a bunch of our science, our modeling, and our evaluation. So we've come a long ways over the last number of months, and we're pretty excited. And then, of course, $90 oil versus $40 oil when we kicked off the G pool makes a big difference too, right? I think we're excited about it, and I realize we don't have a timeline put on it yet, and that's not, we're not holding anything back. We don't know yet. We were sort of releasing to the market that we are moving forward, and we'll have more to come on that as we understand our timeline on that too.
Yeah, so you could be injecting polymers like 6 months from now in the F pool, right? By the end of the summer.
Yeah, technically, we have approval to do it. It's now, going from evaluating the geology, evaluating the engineering, to actually, sourcing out all the equipment and saying, and the cost of that, and saying, okay, well, what's available? What do we have to have built? And what's a reasonable timeline on that, right? Because I'll tell you, like 2 years ago, getting a polymer skid built they were jumping all over us because no one else was doing it, right? At $40 oil. And there was lots of equipment, any equipment we needed to upsize our facilities. I mean, you were able to go out and get it in the market, not new, but you could find great used equipment and bring it in and tie it in. That market's a lot tighter now that we're in this price environment.
Yeah. Hey, what, and on that, what's the availability of the rig you need, the drilling rig and, completion equipment? Are you seeing any problems with getting casing or anything like that?
Oh yeah. No, casing, steel, it's certainly tight. And rig availability, I think it's more people availability is a real major issue. We've had times where, you get a pump go, a well go down, and we used to be able to pick up the phone, have a service rig out there the next day if you wanted it, and we're not in an environment like that right now. I mean, it's it goes back to what you're saying. A lot of those old wells that back at $40 or $50 oil, they went down. You left them down, right? And now though, that 7 or 10 or 15 barrel a day well makes money. So you get that, everybody's getting that service rig out and going, and there's just only so many people to work those things.
Right. What's the timeline? So when you do this 3-well program, you'll go out and you'll tie up the rig to drill those 3 wells, just bang, 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 one right after the other, right?
Yeah.
And how much time does it take to drill and complete one of those producing wells?
Well, it's about a week to drill. Okay. And then, tie-in really just depends on, is the pad already tied in, or is it a new pad? I think most of our, some of our drilling, I would think this summer is probably a new pad. So then you're going to extend a pipeline up to that pad. So, it could take as much as another 3-4 weeks to get those wells online.
Yeah. And then all your wells out there, they're tied to central production facility, right? So the trucks come in there, can easily get in there.
Correct. Yeah. So we, in each of our pools, we've got our own facility, sort of centralized facility. All of our pads are tied back to that central facility. At that facility, the goal is let's take the G pool as an example. The goal is then to get the oil to sales spec, which is 0.05% or whatever water, and so then all that water that gets taken off, it goes through our system. We now add the polymer to it, and then it gets distributed back out to our injectors.
Yeah, you're just re-injecting the produced water.
Exactly.
Yeah. So you don't use any fresh water out there?
No fresh water. Our source is actually another deeper zone, saltwater zone. That
okay, good. That's good.
Yeah,
that's helpful. Let's talk about your hedges. You have a slide on your hedges, right? Can you go to that?
Yeah.
It's in the appendix
at the bottom here. Yeah, there you go.
Okay. What's your hedging strategy? What volume of oil do you have hedged for 2022? And then explain those hedges that say WCS differential hedge. What does that do?
Sure. Yeah. And so you can see there's a whole lot of hedges on here. Our approach is we never like to just do everything all one day. We like to take sort of a call it a dollar cost average approach to things where, just like the market, you're never going to time it perfectly. So, that's the approach we bring here. We also see where, we've been in a rising price environment. So we've been, do you really want to lock in a swap at 65 or 75 or 85? So what we've been doing is then protecting a floor, right? And so if we know we can be break even on our wells down to $20 WTI or whatever the number is, $25 WTI. And so then we lock in a floor of 30 or 40 or 50 or 60. We can then sell a call, and at some point in the future, and we've been timing it, hey, we think the price is going up, sell that call for, $80. I think the last one we just did was $100.
That one on the bottom.
Yeah, $100. So again, we're not paying then. We cover the cost of buying the put or the put spread, And so that gives us a coverage, and we've got a nice floor that we know we can still make money at and pay the bills. And yet we haven't capped ourselves. Well, we've capped ourselves for 275 barrels a day at $100, for the fourth quarter there. And so, it does provide some, it provides that base protection and gives us pretty good access to upside there, and doesn't cost us anything. We've covered it off. With the premium we get as selling the call, we've covered off the cost of the put.
Yeah, without calculating it, I guess I could go there and calculate. But how much of your production, like what percentage about?
Roughly, call it roughly 25%, I think, is where, or 25% of our PDP number. Yeah.
Yeah, because they go, as you can see, people looking at the screen there, you can see that those ones at the top of the screen, they fall off. You even got some that fell off at the end of January. So they're falling off, and you've got to kind of go through each month at a time there. But it's like 25, 30% of the production is hedged, and you got some good collars. Want to explain for some of the people on the call, what is a three-way collar? What does that do? What's the third way, I guess?
Oh, God. It's really just a way that you get a little bit of a less cost on it. And I don't know. I'm not the right guy to even explain.
Well, what it does, you have a floor, but then it limits the floor. It limits the liability for the counterparty, because they'll only have to cover the difference between, say, that one at the top, that's the fourth line down. They're only paying the differential down to 40. Like if oil went negative or oil went zero, they wouldn't have to make up the difference.
Right.
Well, so your ceiling's capped at 79, the call, right?
That's
and
right.
Then your floor is 50, but then they only have exposure for $10 down to the 40.
For 10, but actually how that works then though is you're basically always below 40. You would always lose $10. Only right. So or you're only covered for an additional $10. You're right. So you give up a little bit of protection on the downside for a cheaper cost. Right?
Yeah, and unless there's some huge difference in the market, that those floors are not going to have any impact. the impact's going to be on the upside, probably.
That's right. Well, in this market, that's right.
Yeah.
And so I think you had asked about the WCS differential.
Yeah.
And what is that? And so that's that discount from Canadian crude in the US, right? So for heavy crude, today it's about, I think it's trading at about $13 or $13.40, something like that, of this discount. And that's what I'd said, when you calculate our wellhead price, you take the what are we, 90? If I do it on my calculator here, we're $92 WTI today, minus $13 gives you 79 US. You times that by 1.27 to get it in Canadian dollars. That's $100 Canadian minus our $4 quality adjustment. It would mean we're getting today a wellhead price of $96 Canadian.
Okay, and then you take off the 1950 for the differential.
Well, so in this case, it's good actually, we talk about this. So what had happened is we were starting to see the differential last fall start to get a bit shaky. I can't remember even now exactly what had happened, but there was some concern that the differential was going to blow out in the short term. And that's why, it looked as though December and January could be very bad, right? So
this limits your differential.
It locks in a differential. So in the end, these weren't great hedges. We didn't give up a lot, but we certainly have lost money on these because the differential never got, it didn't get locked in at that high. It ended up being 17 something or $17 or $18 for December.
Okay.
And then I think it was 13 13 or 14 for January, something like that. So
yeah, we're hurting. We need more heavy oil. I mean, we
well,
can get it down here.
and in this case, I know what it was. It was our storage levels were basically at tank tops in Canada.
Okay.
So when that happens, there's no place for oil to go. And then all of a sudden, that's when you see the differentials blow out, and you end up finding you got to just find more ways to get it to the US, right? Because that's our buyer, right? So it became a pretty major concern. However, that being said, on a macro, the differential is less of a concern than it has been for years. We have more pipeline capacity takeaway now with Line 3 and some other debottlenecking that they've been doing. We've got Trans Mountain, which it is delayed with some of the weather and the flooding and different craziness we've had here in BC over the last number of months, but it's still on track for at some point next year to be online. So we'll have more pipeline capacity takeaway in Canada than production for the first time in a number of years.
Okay, good.
Yeah.
The whole world's short of above ground oil. Let's talk about the future. Okay, so you've got maybe 25 more development wells to drill out there at Atlea Buffalo, but what's after that? You're talking about more exploration. Is there acquisition opportunities in that area?
I don't know if I just limit us to that specific area. We've scoured that area pretty good, and the assets we have there are certainly the assets that we've wanted there. But yeah, we're always looking and reviewing opportunities. We're pretty picky. We got to see an opportunity that we can pick up an asset for a reasonable acquisition cost, that we don't pick up a whole bunch of liabilities, wellbore or facility liabilities with that acquisition, and that we see significant upside so that we can bring our expertise in, seismic and horizontal drilling and EOR. We can bring that to add value to an asset that we purchase, right? I mean, we're not looking to grow barrels and just for the sake of growing barrels. We need to see acquisitions, or we'll do acquisitions where we really strongly believe we can add significant value either through the drill bit or through engineering and EOR.
Yeah, I wonder, is there any potential little public companies, other Canadian juniors that you could, merge with to eliminate that would eliminate the overhead of them being public? And I don't know, there's not
many left.
Yeah, that's the problem. That's a small list. Yeah.
It's most didn't survive. I think, I've probably said this before. I think back, 10 years ago, I had a little spreadsheet with all the little juniors in Canada that were publicly traded. And I think there were 75 names on there. And when I updated that not too long ago, I think there's 3 or 4 of us left.
And I tell you, Don, by pure luck, I think I picked the best 2 Canadian juniors with you and in play in all of Canada.
Yeah, well, yeah, they've done a phenomenal job as well, and they're consolidating up in the Cardium. Doug's done a great job.
Yeah. I missed a question here on the hedges. Are your hedges settled based on an average selling price for the month, or is a point in time like where the January NYMEX contract settled?
It's always it's the average.
Okay, it averaged during the month where it traded during that month or something.
That's how we're paid. Yeah.
Okay, that's good, because that there was a problem with the NYMEX gas contracts. Had a big spike on the last day of trading. They closed about $2 higher than they had before, and everybody was worried they were going to have to pay all that differential. Anyway, let's see. Let's talk about since the corporate guidance on a specific debt repayment goal, since there's a corporate guidance on a specific debt repayment goal, specific capital budget objectives, and specific dollar amounts on the share buyback plan, is it reasonable to expect more concrete discussion on a dividend plan once the debt is paid in full or gets back to where you want it to be? And that could happen as early as the third quarter. We could literally be 6 months away from the board deciding if you're going to have a dividend or not, right?
Yeah, and I think there's a couple things in that question I should address, and I brought up the guidance. So what, the specific goals or budget that really is laid out here is the 2,600 average price for the year target, the 3,000 exit, and then at $75 oil, that's 37 million of cash flow. And, we've laid out about $9 million in Capex, which then the rest is just the math that falls out with that, right? So 37 minus 9 is $28 million of free cash flow. And, without doing, we haven't allocated specific amount of money to share buyback, and so that falls under this, that $28 million of free cash flow falls under what I would consider today as a bit discretionary on where that's going to go. That's the balancing act, right? Which I think we talk about here. We have to balance then as a company growth, debt reduction, new acquisition opportunities, and returning to shareholders, of which within that return to shareholders, depending on how you view return to shareholders, I view a lot of different things as returning to shareholders, but certainly I think the main question is, shareholder buyback and dividend. And so, again, we haven't laid that out. I think it's very difficult as everyone likes to remind me that we're a nano cap, to be making, large promises. Although I'll say again, and I'm sure I said it down in Houston and Dallas when I was in person, I love dividends too. Don't get me wrong. I'm a shareholder.
Yeah, you own stock too.
I like cash.
Your wife likes cash too, like our wives do.
And so it really, though, it has to be, and so again, it's along the same lines as everything else in our business and how we run everything else. I am not going to make promises that I know I don't know what will be there in a quarter or 2 quarters or 3 quarters. I can honestly tell you that anything that we do, whether it's dividend or whether it's an acquisition or whether it's buying back stock, you're doing it because we believe as a company that is the best return and that is the best value add that we can do for shareholders at that given time.
Right. Yeah. Yeah. I mean, when your shares are trading below net asset value, I mean, it's a no-brainer to buy back the shares. So, anyway.
Well, you would say that, but I've had lots of shareholders that everyone has an opinion on what we should do, right. and that's right. I love hearing all those opinions. I really, and I guess what amazes me is the very, the wide variability of what everybody believes should be done. I mean, there's been lots of questions here, or a few questions on, one on debt. So obviously someone's concerned, again, hey, you're going to continue to get that debt down, right? And I would agree with that, getting that debt down. We've had a few questions on growth. Well, where are you going to grow? We're going to go after Atlea. So there's someone out there that's obviously already says, oh, geez, if they only got 25 locations, they could drill those over the next 5 years or 1 year if they wanted to use all their cash flow. Where are they going to go next? Right? So they're concerned about growth of the company and where do we go long term. And then, again, there's a especially in today's oil market and publicly traded companies, what's the return? Are you going to buy back stock? Are you going to pay a dividend? So it's quite a variety of ideas and expectations and opinions on what should be done.
Yeah. And we're still in the proving point, where is oil going to settle? I was on a webinar yesterday with the World Oil, does an annual deal, and they got tons of data, but they say the right price, or where they think the oil price would be if you didn't have all this geopolitical risk stuff going, would be like $74 a barrel US. Of course, then they immediately say, but we don't see the geopolitical risk going away. So the bias is to the upside on where oil price can go, I think.
Well, it's interesting. I mean, there's the political risk, but there's the inventory risk. I mean,
Oh yeah.
we're back, from what I've been reading, we're basically back to where we were on a demand basis before COVID at just over 100 million barrels a day. Yet we don't even have our jet demand back to anywhere close to where it was before. And we're not, as an industry, we're not spending anywhere near the capital that we used to in order to find new reserves and find future supply. And then you look at the inventories. It's pretty scary in some ways if that's, if you're in some shoes, where our inventories are at globally. And then, you and I talked a bit about just before the presentation on OPEC and they've been asked and called upon to bring on 400,000 barrels a day a month, or 400,000 for the month, and they haven't been able to achieve that for numerous months in a row. So why is that? I mean, if you have that opportunity to make that extra cash, why wouldn't you be doing it when you're allowed?
None of the OPEC. I tell people all the time. No, people say, well, isn't there a lot of production out there they could bring back online? And I'll tell you, there is nobody. And no OPEC country is producing below their quota because they want to. They want to produce that. They just can't. And you got over half the OPEC plus countries cannot meet their quotas. And I believe Russia is one of them. And there's also, you always have shut-in production that's easy to bring back. And then you have other upside capacity that's going to take some money spending, and their wells deplete like everybody else's. And I just never thought they could get back to pre-pandemic level without spending a bunch of money. And I don't see it happening. So I think they're already at peak production, and I don't think there's any production shut in around the world anywhere.
I mean, the bearishness or the things to be cautious of are probably, as we know, the Iranian barrels. And there's I don't know, I've seen estimates anywhere from 80 to 100 million barrels of floating storage that could hit the market fairly quickly. But again, that's one day.
Yeah, there's always floating storage. It isn't like there's a bunch of empty ships ever. There's always floating oil running around the world. And so, there's no big, and I truly believe that most of the Iranian production is being sold to China. China doesn't give a damn about the sanctions, and they're buying their oil because they're getting it at a discount, because they're selling their oil to the Chinese at a discount. China will take every barrel they can get from them. So we'll see. Hey, one last question, then we'll wrap it up here. But how that trucker strike that we're seeing on the news down here over in Quebec, is that having much impact in your area? And does that have any impact on you getting any, supplies or anything?
I haven't seen any issues yet. I think if these border crossings are blocked for a significant period of time, I would expect we will see some issues there. But no, I haven't been made aware of anything yet. No.
Okay. Well, Trudeau needs to wake up and get off this mass mandate stuff. The truckers control our lives, guys. Without them, we're in big trouble. And you'll see empty shelves at the store at some point in time. Yeah. Anyway, so Don, thanks a lot for doing this. I think it's very helpful to everybody. I think you're doing a great job. Keep it up. I'm really looking forward to your year-end reserve report, and then you're gonna announce fourth quarter results officially in early April, right? In April sometime. Yeah, probably. It's usually around mid-April. Yeah, around mid-April. Okay. And for those of you, say, why does it take so long? Well, the year end, you got to have the year end reserve report. You got to do all the year end Sarbanes-Oxley kind of stuff. For companies listening to the U.S. and all that. So it takes longer for the smaller companies to get their audit stuff done. Cool. Anyway, so that's okay. Yeah. No, I just add to that. I mean, we always look for ways to save money, and if you push to go faster, it just costs more. So right. We sort of let ourselves fall into the auditor's time frame to be, and that way it saves us money to get these things done. Well, and the good news is then your first quarter report is much closer to the fourth quarter report too. Oh, so. It's within weeks. Yeah. And I always say those are the two most important quarters of the year. So anyway, all right, man. Hey, thanks a lot, and we'll be in touch. Keep up the good work.
All right. Well, thank you, Dan, and thanks to everybody and all our supporters down there.